Good afternoon. This is Oliver Slope, co-founder of Blue Light Futures. Today is Friday, July 19th, and TGIF because this morning had a big wrinkle thrown into it for not just us, but a lot of other folks out there with the global internet outage affecting airlines, banks, etc. So a little bit of a hiccup, but we made it through, and it is Friday. Thank God it is not a Monday. I would not be looking forward to the rest of the week if that were the case. But anyways, I digress. Before we get into the charts and today's price action, do want to get this plug in there. We're going to be doing today's charts from our Blue Line Edge trading platform. If you'd like to give that a try, you can head over to bluelinefutures.com. You can click Trade with Edge and select here Blue Line Edge or Edge Plus. The Edge Plus has options capabilities. The Edge does not. But you can try a free demo there. We've got great desktop mobile platform along with the daily commentary that we put out each and every single day. So again, head over to bluelinefutures.com. Get yourself signed up for a free trial. Now that I got that plug out of the way, we can go ahead and start with the charts. We'll start with corn. Now, there really wasn't a whole lot to write home about. It was kind of a wishy-washy week. We still remain stuck in about this 10-cent range between 403 on the downside and 413 on the upside. So until we get either a breakout above or a breakdown below, I think this range probably continues to represent some pretty good present some pretty good opportunities for shorter-term traders who aren't necessarily married to a bias, whether that be bullish or bearish. So again, I think the corn market kind of neutral here, which I guess is a silver lining that we're just going sideways. That is relief to the market at the very least. Now on the soybean side, it was a little bit more disappointing. We failed against this top end resistance near 1050 a few times here over the last week or so, and that is concerning. Yesterday's price action was this recovery from these lows that took us back near these highs. And the fact that we weren't able to really sustain any momentum following some pretty good export news is certainly a caution flag here into the weekend and does not leave the bulls feeling all that comfortable heading into next week's trade. We had better than expected weekly export sales coming in at something like 74% above last week and 13% above the prior 4-week average. And then we got that big flash sale of 510,000 metric tons to unknown destinations, and typically, a sale that large is attributed to China, although not confirmed. So the fact that we couldn't continue to trade higher on the back of that good news on Thursday was definitely a disappointment, but maybe next week is a new week and we can get back at least in this trading range from about 1035 to about 1050. Until then, I think the bears remain in full control. We really need to get out above this 1050 level to really maybe spark some additional short covering. So that's what we're looking at for corn and soybeans. And then real quick, we'll just jump over to the cattle markets. We just had a cattle on feed report released. It was largely in line with estimates. Let me pull it up here. On feed came in, right in line with estimates. Marketing's right in line with estimates. Placements did come in about 3 or 4 points under the average analyst estimate. So it'll be interesting to see how the market responds next week. Now we have probably sounded like a broken record in the cattle markets here as of late. We feel like there's been ample opportunity and reason for this market to rally higher, but we haven't been able to do it, which is always a caution flag. And we often refer to that kind of like a fundamental rejection. There's reason to rally, but we can't do it. And what is the reason behind that? Well, we continue to kind of believe that the funds probably don't want to participate in a way that they were last year at this time when they got up to 120,000 futures and options contracts to the long side. And what might be keeping them at bay are those headline risks regarding bird flu, an election, the back half of peak demand season, a lot of things out there, a softening economy, which is ultimately the Federal Reserve's objective. So I think with those things kind of lingering in the background, fund participation probably won't reach the levels that it has. Now, that doesn't mean we can't rally. I actually think we can probably get a little bit of a pop, especially in that front month August live cattle contract, so long as the cash market can remain firm. And maybe we see that the board and the cash narrow there, and that provides an opportunity for those deferred contracts to rally. And if it does play out like that, I'd probably be looking at some downward exposure, whether that be for protection or a speculative position. So We are on trend line support. We haven't broken down yet. If we can get back up here near 186, 187 in that October contract, that's been the overhead resistance point really since the start of the year. That would be the spot to maybe look at some downside protection or exposure again. So that's kind of what we're looking at into the weekend going into next week. If you have any questions at all, don't hesitate to reach out. My direct line 312-837-3938, or you can email Oliver at Blue Line Futures. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.